What we're seeing this time around is a V-shaped bottom. It's gone down, it's gone straight back up. And if we do go on to make new highs, and in hindsight, this is a bottom, this will be incredibly rare historically. GDP doesn't go from like 2 to 1 to 0 to -1, right? It's going to go along a 2, and then the next print is 0 and it's -3. It tends to be a lot more of a gap. You can see that Swedish lead indicators have basically collapsed. So that's telling you there's more pain to come. My name is Tian, Head of Research at Variant Perception. So at Variant Perception, what we focus on are leading economic indicators. If you look at the way the economy works, it tends to be more mechanical than people realize. There's a fixed sequence in which things have to happen in the economy. For example, building permits necessarily have to go up before construction activity can pick up. Similarly, if you're an employer, you would typically hire or fire temp workers before you would hire or fire full-time workers. So temporary employment will tend to turn before full-time employment. So if you look for these kind of leading, coincident, lagging relationships within the economy, then it will give you a much better sense of where the economy is going. It's almost like when you're driving a car and you see the car in front do something with the indicator lights, and you know they're going to turn before the car actually moves. That's what we're trying to do with leading indicators. Leading indicators are not necessarily new. They've been around since at least the 1980s. The likes of Geoffrey Moore wrote the original academic papers on it. However, what we are trying to do is actually apply it in a robust and repeatable way to real-world investing. So it's kind of like the Yogi Berra quote about, in theory, there's no difference between theory and practice, but in practice, there might be. And so it is with leading indicators. A lot of traditional approaches to economic research are very theoretical in nature. You go to the World Bank, IMF, download the database, run your model. But in the real world, data is revised, right? You see the GDP print come out, and then a few months later, it's revised. So there are a lot of these issues that if you realize and overcome them, then leading indicators can actually work for you to understand where we're going with the economy. And the final thing to say on that is, ultimately, the key here is to focus on the economy rather than the market. There isn't actually a leading indicator that will lead the market 100% of the time. And even if there was, I probably wouldn't reveal it to you. And if I did, it'll probably stop working. But what you can do is actually focus on where the economy is going and look for divergences between leading economic indicators and market pricing. US equities had quite a large rebound to start the year. By the technical definition, we were in a bear market barely back in December. Now, if it's truly over, this will be one of the rarest types of bear markets we've seen in history. So if you look back at the past 100 years of equity market data, the shortest previous bear markets that occurred without kind of a major recession scare was 1990 and 1987. In both cases, the bear market lasted about 3 months. Right now, we're about 5 months in from the original sell-off. Even for those very short bear markets, what you saw was actually a retest of the lows, right? And this is ignoring all the major kind of recession-related bear markets, right? Where markets fall, it takes years to recover. Even for the kind of very short ones, it tends to be more of either a W shape or even a triple bottom one, and then a rally. What we're seeing this time around is a V-shaped bottom. It's gone down, it's gone straight back up. And if we do go on to make new highs, and in hindsight, this is a bottom, this will be incredibly rare historically. Just in terms of how markets work, usually people want to retest support and resistance levels just to get a sense of where the real buying and selling pressures are. I think often narrative could also catch up to prices. Again, if you take a step back and just look at historical precedent, whenever you have a 10% plus down quarter in US equities, 80% of the time, the following quarter is being a win. The only exceptions are basically in the depths of recessions. So because we don't have an imminent recession, a rebound is kind of expected. When you drill into the flow and positioning data, you see that basically people got very short, and even throughout the rally this year, shorts have basically held on. There's been continued outflows. If you look at US ETF flow data, that's flowed out. You can track kind of CTAs. They're still short. Macro funds are short. So I think it's been a case of more of a squeeze higher. And because you have a squeeze, you have this kind of relentless looking V shape up. But I think a lot more of it is positioning and flow driven than the kind of narrative, right? You have a big down quarter, people get short, it squeezes higher. The next stage, which is where we're at now, is what happens now when we start reacting to growth data that disappoints, to earnings downgrades. Maybe margins are being revised lower, but sales projections are maybe still growing. That needs to come off. So I think that's why we're at a tipping point, if you like, in where markets are going. The narrative is focused around the dovish pivot by the Fed. And there's a lot of talk that this is analogous to the 2016 reflation trade when Yellen, again, backed off. There was the whole Shanghai Accord, currency coordination. I think investors are drawing a lot of analogies, and it's easy to see the appeal of it on a kind of superficial level. There isn't an imminent US recession, the Fed's more dovish than expected, and China's starting to ease, right? So if you take all three of those, you're like, okay, this looks similar to a 2016 setup, in which case the playbook is, go long cyclicals, go long commodities, there's going to be a wave of liquidity coming. When you take each of those and start drilling down and digging into it, what we find is that the data does not match the narrative. Back in 2016, it was actually very consistent. Leading indicators of both global growth and liquidity had already been turning up. So you had the hard data pick up to support the narrative, and that could fuel the market move. I think today is more of a case of the narrative has front run the data. There's zero signs in any lead indicators that the data is about to come through. So we have this setup where the narrative and market's up here, the data is going to be there, and you're going to have an extended period of data disappointments. And the question is, will markets be able to hold up to that? And given the historical precedent about how long bear markets typically last, the fact you need a double bottom, I think the risk reward, the probabilities really do favor retest the lows now. I think the first thing to address is actually recessions. So we tend to think about recessions slightly different from how most economists or investors think about it. Technical definitions about two negative consecutive quarters of growth, it's all fine. But in practice, what you really care about is when recessions cause large cascade falls in risk assets. And the cascade fall is really kind of when there's a positive feedback loop between the economy and essentially financial markets or sentiment. So the economy worsens, earnings worsen, investors react and drag equity prices down, which then in turn further dents sentiment, further dents investment choices. So you get this positive feedback loop. This is almost our interpretation of what Soros meant by reflexivity in terms of when these positive feedback loops kick in. So that's kind of how we like to think about recessions. And as such, you need to think about them as regime shifts rather than this economy, like the standard quadrant approach where the economy is accelerating, decelerating, you go into recession. If you actually look at the data in practice, GDP doesn't go from like 2 to 1 to 0 to -1, right? It's going to go along a 2, and then the next print is 0 and it's -3. It tends to be a lot more of a gap. So you have to kind of think about it as a regime shift. And the way we tend to model that is to focus on simultaneous deterioration in hard and soft data. For example, if credit spreads are widening at the same time as initial claims are rising, that's a very bad sign. That's the first sign that the positive feedback has already kicked in. Therefore, we're in the kind of recession loop, and then it's important to get defensive immediately. What we've seen so far, and this is why I think people drew the analogy to 2016, is that financial markets were discounting a recession, but the hard data didn't react. And so, if you just don't think of it as regime shift and just think of it as a standard model, then you'll be like, 50% risk of recession because all your financial market inputs are giving you a warning flag, but the hard data isn't. But if you think about it as this positive feedback loop, that's why we haven't seen it yet. The other thing about thinking about it as a regime shift is that these things can move quickly. And so right now, the situation we have is that lead indicators are not pointing to recession, but they are pointing to a growth slowdown. If you look at US data, building permits, right, that's stopped growing, that's declining. Real money growth, real M1 in the US, that's fallen a lot. A lot of the lagged effects from the previous tightening of liquidity, the previous rate hikes are still feeding through. So there's the danger that the hard data is about to deteriorate, which might happen when sentiment is so elevated. Then the sentiment might come off as well. So ex ante is very, very hard to predict when these recessions hit. I see all these forecasts like, June 2020, right, which is going to be the recession day. We don't have a model that can time it necessarily, but what we do know is when the first sign is going to kick in. So right now that hasn't quite kicked in, but because leading indicators for the US economy are rolling over, in addition to a lot of things like the fiscal stimulus, the effects are rolling off, the risk is very elevated. So I think that's the first thing that's a bit different to back in 2016. The second point is clearly the Fed. So if you look at Fed pricing, if you look at 1 year forward rate hikes priced, the chart looks very similar, right? You have 2-3 hikes priced in for the year, and then suddenly the markets go to pricing cuts. But I think that's kind of where the analogy almost ends with 16. The difference today is that labor markets are even tighter. You're 3 years further in. Evidence of wage growth is already coming through. If you look at core inflationary pressures, it's not surging, but it's actually moderate and present. Inflation is one of the most lagging indicators. If you do something as simple as plot the ISM against core CPI, you'll see it's almost a perfect 2-year lead if you push ISM forward. So because we've had that previous surge in growth, the underlying inflationary pressure is there. The market is kind of very focused on transitory headline factors. So people are focused on the dollar, on the falling oil prices, and therefore headline inflation will take a dip lower, and the markets are pricing that. But once that transitory effect is out of the way in the second half of the year, the core underlying inflationary pressure is still there. It's not necessarily so much that it's going to cause the Fed to aggressively hike, but it's certainly enough to prevent them easing policy. And that's really the key. The move so far has been from pricing of a very hawkish Fed to further tightening of liquidity to now pricing, okay, they're going to stop and pause here. But just because they pause, it doesn't mean things are going to start improving immediately. The Fed balance sheet is still actually contracting. Now, they might announce a taper soon, and obviously that's kind of widely anticipated. But if you actually look into Fed net credit, if there was, even if they pause, because of the year-on-year impact in terms of the base money flow through to kind of commercial banks, it will actually still cause a contraction of liquidity. It's important to think about defining liquidity correctly when you want to think about the Fed. Right now, I see a lot of commentary on indices like the Financial Conditions Index, right? Goldman have one, Morgan Stanley have one, and I think those indices are not particularly useful as leading indicators. They are by definition coincident. Within the definition, they have credit spreads and equity prices in them. So you can't really use it to lead where asset prices are going. They're just telling you equities have fallen already, or they tell you equities have rallied already. The key is to focus on what we would call excess liquidity. And we define that as real M1 growth minus economic growth minus inflation. The intuition is that money is created from thin air by both central banks and commercial banks. And once it's created in the system, it basically has 2 major uses. It either flows to the real economy, or it goes to supporting asset prices, or it goes to inflation, essentially. So if you take the change in M1, remove the impact of inflation and economic growth, then what you're left with is kind of the pool of liquidity available to support asset prices. And on that measure, things have been declining and they're still in a downward trend. Now, it's also important to explain why we focus on M1. So a lot of analysis typically only focus on very broad measures like debt to GDP, or only focus on, say, the Fed balance sheet. I think that's why you have some of these spurious charts where people plot the Fed balance sheet against S&P, and it's perfect correlation right up till, right up until it started tapering, and then suddenly there's divergence, right? And I think the reason is because people need to understand the definition of money. The balance sheet itself does not capture the whole concept of money, right? It's capturing essentially Fed balance sheet, cash and reserves. But because commercial banks can also create money from making loans and deposits, you need to capture that impact. But if you use broader measures like M2 and beyond, that's too broad, then by the time you see the data turn, prices likely would already moving asset prices. So broader measures like M2, debt to GDP are more coincident to lagging indicators. They can tell you structurally where you are, but they don't give you a cyclical lead. And intuitively, if you think about it, it's because things like M2 are defined as longer term savings. So if you imagine the typical commercial bank balance sheet, when you secure longer term savings, you're typically matching up to some assets, right? So by the time it's reported at the central bank that M2's gone up, they've probably already done something with the longer term funding. They've gone out, they've bought assets, or they made the loan already. So a lot of activities happen, and then you see M2 go up. But something like M1, which is basically just cash and demand deposit, because it tends to be zero interest, you'll notice when that goes up, typically people are going to do something with it. So it tends to be slightly more reactive. So that's why we focus on M1 and kind of M1 equivalent measures of narrow money to see liquidity. So if you define it as that, what you'll find is that it actually tends to lead asset prices by about a year. So you have a lot of time to prepare in the event that you see a major turning point. But also what you see is that right now the pictures are looking a lot more dire. That's a very interesting point, and I think someone who also appears very regularly on Real Vision, Ben Hunt. I'm a big fan of kind of his framework, which is this idea that basically in a nutshell, the Fed is here to safeguard asset prices and things are going to be fine. And I think I have a lot of sympathy for that. But if I really think about it from an institutional point of view, I think the main thing the Fed is here to do is to preserve itself, right? It's about preserving the institution of the Fed, widening their mandate. So what we've seen is that every single time emerging from a crisis, the Fed's been able to broaden its mandate. Suddenly financial stability is on their cards, right? They can start regulating banks. Every time we get a crisis, as long as the Fed steps in, they essentially usurp more power from the Treasury and politicians, and the institution grows. I think that's kind of a more holistic framework to think about the Fed's reaction function than necessarily they are targeting asset prices because, power was hired by Trump, so he has to make sure Trump gets reelected, so he has to, push the market up. Yes, absolutely, they will step in if there is a, serious crisis or crash. But I think the bar is higher than people think for the genuine kind of actionable Fed put. I think verbal easing is cheap. The issue is going to come when we are retesting the lows, but underlying inflation pressures are starting to come out, and then I think they'll have to kind of straddle the line a bit more. So what you end up with is more of a constrained Fed rather than the kind of blanket dovish surprise all the time. Anytime you talk about China, we need to first actually talk about the credit transmission mechanism in China and how it is ultimately a bit different to what most Western investors probably grew up with, right? Because we're taught in terms of how you have fractional reserve banking, right? This is how Fed, ECB, Bank of England policy works. But in China, the credit allocation mechanism is somewhat different. Ultimately, it's about a lot of connections you have, right? If you're a state-owned enterprise, you have connections, you have implicit guarantees, there's unlimited credit for you. If you're a private enterprise, you need to go to the bank for a loan, it's actually a lot tougher. And I think this is why they've had so much trouble easing so far. If you cut required reserve ratios, you mandate banks to go out and lend to private enterprise. Even that is taking a long time, right? So it's only basically end of last year where they imposed the quotas, and you see in the new lending data, how do banks meet the quota? They make short-term loans, right? So the surging loans is actually mostly less than 1 year duration. So the credit allocation mechanism in China doesn't really work like a traditional kind of monetary policy transmission mechanism. And if you go look at, for example, China excess reserves data to M2, you can see a big divergence in the past 2 years. So M2 growth has steadily declined, but reserves are built up. So you see the binding constraint is not a lack of reserves. So cutting the required reserve ratio is not going to help you. Does that mean there's a lack of liquidity in China? No, but historically it's come from shadow finance. And so this is where I think is the key on China today. Historically, there's been overwhelming demand for credit from the private sector that's been mostly serviced through the shadow finance sector. And what you've had in 2018, with the asset management reform and these things, the policies that the government pursued in deleveraging is essentially they basically, punched shadow finance on its head, right? And now it's fallen on the ground. The difference is you're not helping them get back up, you're just letting them try to get up on their own. So a lot of the commentary now is, okay, deleveraging is at the end, we need to think about growth, but also pay attention to financial risks. A lot of the talk is almost still trying to kind of achieve the two objectives, but with more of a tilt towards growth, rather than kind of the blanket support growth at all costs. So I think that's why, the key is really how loose does shadow credit get? And that's going to be what determines whether this reflation cycle is really a 2016 style big, monetary and fiscal largesse, or it's going to be more targeted. The evidence so far is that it looks a lot more targeted in nature. If you look at non-bank financial institution assets, look at the balance sheet, it's not growing, right, in China. If you look at credit spreads or lending rates for lower rated corporates, so A rated and below, it's still, say for 5-year lending rates, it's still double digits. So the credit that the PBOC wants people to get, they're not getting. The credit they're making available is only available to the big guys. So I think that's really where we're at today. Do they want to support growth? Absolutely. Are we at the pain point in China? Absolutely. That's analogous to 16. I think the difference this time around is Xi has obviously consolidated power a bit more. I think there's less of a visible threat to him. I think there's more underlying, but less of a visible threat in terms of the handover of power, right? Since he changed the kind of the laws around president for life and all that. So I think then he has more of a slightly longer term view in terms of his reform efforts. So I don't think he completely wants to give it up. But having pursued this deleveraging for 2 years, I think on top of the trade war kind of external shock, what you have is he is kind of at the pain point. So they are really stepping up support for growth, but at the same time they want growth on their terms and not kind of through the kind of standard shadow credit liquidity. So I think that's why investors are going to be probably somewhat disappointed by what's going to happen in China. Like even if you look at the A-share rally, right? Obviously we've gone parabolic in February, and then after that, immediately what the politicians, everyone came out talking about was, clearly they don't want a bubble, right? They want a slow bull market. They want to show that it's a institutionally sound framework, encourage foreign inflows. So there's a lot of attempts to kind of stop the kind of big kind of reflation bubble kind of trade we saw back in 2016. The first thing to say is the capital account is a lot tighter than back in 2016. The government's made a lot more of a concerted attempt to shut off a lot of the channels through which money managed to get out, right? In theory, you've had capital controls all along. In practice, when you looked at how money got out previously, it was actually through the trade channel, right? So, very famously was over invoicing of imports, under invoicing of exports, right? Because, the trade balance is so big, you can get a lot of money move without it looking visible. Now, obviously, there's a lot more talk about One Belt, One Road and a lot of these various things that money's flowing out. But I think the quantity of it is a lot less, and they're a lot more serious about controlling it. So that's one thing that's probably somewhat limits how much is going to flow out. But the underlying pressure is there. So I think that's why, again, the PBOC has to strike kind of a balance where they can't do anything too dramatic with the RMB, because the saying, there's like a famous Chinese saying, right, which is essentially roughly translated says, the guys at the top come down with a policy, the guys at the bottom come up with a solution. It sounds a lot snappier in Mandarin, but the basic idea is if there's a will, people will do something to counteract it. So the PBOC is stuck trying to strike this fine balance between keeping the RMB reasonably stable, allowing some outflows but not too much, and hope that there's not this flood of money out. And so I think that impact will be a lot less, and it's already visible, right? If you look at Australia housing data, Canada housing data, right? The two kind of prominent Western countries that have seen a lot of Chinese money. If you look at Vancouver housing transaction volumes, right? It's been terrible. It's been down pretty much for the past year. And equally, if you look at things like infrastructure investment, I think it's probably not going to be to the same magnitude as before. Because again, there's like a stock versus flow argument where even if the flow number looks very big, because the stock in China is so massive and has been growing, the year-on-year impact in the entire stock is declining over time. So there was a lot of excitement about the issuance of local government bonds now. And yes, it's going to be great, and it will be a direct boost to demand. But if you look at it in the context of the total stock of total social financing, it's tiny. So I think, again, the kind of expected rebound will not be as big there. So that means the flow through to commodity markets will be a bit less. I think the main impact will still probably come from the economic lead lags. So if you plot, say, China lead indicators against Japan, against Germany, there's a very good kind of 6 months lead, right? So if China's doing badly, then Japan machinery orders collapse, right? German export orders collapse. And so there, the reliable relationships are there. So in China, what we're seeing right now is more of an L-shaped bottom. So leading indicators have bottomed for probably at least 6 to 9 months already, but we haven't seen that rebound. Sentiment's picked up, but the data hasn't picked up. And basically why? It'll be things like Chinese M1 has not reacted to the data. You see this clear divergence between M1s continuing to decline, yet other measures are kind of stabilizing liquidity. So that's one sign that something's wrong with monetary policy transmission, and also there's not enough liquidity coming out of shadow finance. If you look at stuff like trade inventory circulation, right? That's not at the same pace as it was. So those are very good proxies and lead indicators for global trade. So we know the global trade environment is not great. Obviously, one part of it is, trade war, but another part of it was there was an organic slowdown anyway. So again, these are all feeding through to more of an L-shaped bottom than the kind of V-shaped bottom we saw in 16. If you go back to the beginning of 2016, China leading indicators were already surging by then. So was liquidity. It's a very different picture today. So once again, it feels like the market's kind of got ahead of itself. The fundamental structural problems in Europe still haven't changed, right? In terms of the really big picture, which is, the euro is still a straitjacket on a lot of the peripheral economies. The general kind of pickup in productivity and growth is going to continue to disappoint. So that part hasn't really changed. The difference, though, is that back in 2016, what that translated into was this concept of there's a huge output gap. We can ease, to our heart's delight, and there will be no consequences, and therefore we can reflate. And obviously, with the TLTROs and the Q and QE, eventually you got money growth picking up. Today, labor markets are much, much tighter. Wage growth is already picking up. If you look at, labor shortage surveys across the construction sector, it's surging, right? If you look at these on 10-year charts, it's off the charts kind of how tight labor markets already are. At the same time, you have kind of this organic growth slowdown because of, the likes of China slowing. A proxy we like to use for China, for the Eurozone is actually Sweden. So what's very interesting is that these smaller open economies tend to be really sensitive to global trade flows and to global economy. So they tend to actually move slightly before their kind of bigger neighbors. South Korea is very well known as like the China proxy, for example, Taiwan. But Sweden does that very well for Europe. And you can see that Swedish leading indicators have basically collapsed already as well. So that's telling you there's more pain to come. I do think, markets have obviously, because the coincident data is already disappointed in Europe, people have gotten onto it. And so markets are now anticipating the ECB going to start easing, right? Obviously, they announced that they're rolling over the TLTROs recently. But if you look at kind of the totality of the package announced, a lot of it is about just rolling over the kind of tranche of TLTRO2s that are basically expiring in 2020. The policy is actually about saving the banking system, right? Because we know Europe, essentially the banking system is probably insolvent. So the ECB has to go in there and just keep making sure everybody can get financing to keep things going. But TLTROs only address the solvency issue. I don't think it addresses a general boosting liquidity. You would really need the kind of QE type thing we saw in 15 to really kind of get money growth going. And so far that hasn't come through. And indeed, you see kind of a very similar picture about how the monetary transmission mechanism is broken, just like we say in China. In Europe is kind of similar, right? If you look at excess reserves to M2, these things just, the multiplier is still going down. So, I think because the labor markets are tighter within the Eurozone, but the economy is slowing, it's very analogous to kind of what we kind of just talked about with the Fed, where because you have a tight labor market, but potentially the economy is going to slow, the central bank is somewhat hamstrung, and therefore the bar for action becomes higher, both on the up and down side. And so I think that's kind of where we are in Europe. Leading indicators are down. There's divergence between the rising market. A lot of the commentary and sentiment have turned very bullish, all-time highs. The cheerleaders are kind of back, that the risk reward for a retest of the lows on equity markets make a lot of sense. However, I do also think it's possible to have a hedge against that. That's basically also by itself a very good risk reward trade, which is actually Fed Funds Steepness. Now, specifically what that means is there are futures on literally the Fed fund rate that are priced every month, basically out for the next 2 years, right? And what we see right now is that there's 8 basis points of cuts priced in for the Fed for the whole of 2019. So you kind of have a situation where if equity markets are so exuberant, why is fixed income markets so concerned that they think the Fed's going to cut? So there's a big divergence in of itself there. So if you do put on a bearish kind of equity trade, I think also putting the steepener on can make a lot of sense, right? In terms of putting a bearish trade, I think options make the most sense, right? Just vols kind of gone off a little bit so you can cap your downside. So in the event that, say, the thesis doesn't work, maybe we get some kind of magic trade war resolution, all the tariffs go back, maybe Powell does try and get Trump reelected and starts pumping liquidity like crazy, that you don't lose that much. And ultimately, because there are cuts pricing, he can't really cut into that environment. He'll probably just do something with the balance sheet. So you make something on your Fed Funds Steepness. In the event that we get some kind of equity rally that isn't Fed-induced, then as you mentioned earlier, the Fed will probably need to hike rates, in which case you'll make money on your steepener. Or in the event that that we do go for a retest, you'll make a lot of money on the equity shorts, but at the same time, I think you won't lose that much on the Fed fund steepness just because it's already 8 basis points of cuts priced in, and the bar for the Fed to ease, as we mentioned, is a lot higher, right, in the base case scenario, just because inflation pressures are still present, labor market is so much tighter. The reason we highlight the US is there really is the greatest divergence between leading indicators turning down and markets rallying. So I think that's what creates the kind of opportunity. Even though superficially it might seem like today is a replay of the 2016 reflation trade, there are some key differences. Firstly, the US economy is set to slow, not accelerate. Secondly, the Fed is a lot more constrained than they were back in 2016, mainly because of tighter labor markets and underlying core inflationary pressures, which will become more visible once the headline impact of lower oil and dollar is out of the way. And thirdly, because China is not easing in the same way as back in 2016. Back then, it was about supporting growth at all costs. Shadow credit got a big boost, huge, floodgate of liquidity. Today, it's a lot more constrained in China as well. Yes, they want to cushion growth, but they also worry about shadow finance, and they're not easing up as much as people think. So in conclusion, I think markets have front-run that narrative, and the risk-reward is very much now for a retest of the lows on equities, which would be in line with every single historical bear market pattern in US equities over the past 100 years.